Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to dive back in. I want to get to some things here for you that may be of some value, I think, on the investing. So we'll take a look real quick at the roadmap again on the last piece. This has to do with the long-term fund. So on your long-term fund, we're talking about things in the market as an example. Stocks, bonds, mutual funds. These are also your retirement accounts, IRAs, SEP IRAs, 401s, all of that. Now we're looking at the long term. And what are we doing is you see to the right there, I'm showing different rates of return. Historically, I know we're in low interest rate environment still, though it is changing. Rates are going up, and that's part of what this volatility is about. But if we look at the long-term fund, that's where we're looking to get enough money to stay ahead again of inflation and taxes, protect the purchasing power, and those are the accounts we'll be pulling income from at some point when we don't have wages, right? When the paycheck goes away, how do we replace it? Well, we've got to have the savings there to do that in many instances. Maybe you've got a pension, maybe you've got other ways that you're going to have income, maybe you have rental properties, that kind of stuff, well, or your investment accounts, all right? In real estate, kind of factors into that a lot of times for many of my clients. So here's where we're going to take income from that. That's going to be used to help replace that paycheck and take care of our operating fund and as well as emergency fund and the rest. All right, so the next slide we'll take a look at. And this has to do again with volatility. How do you invest in? We talked about investing. We're talking about asset allocation. We're talking about portfolios. We've talked a little bit about how other investments work or how annuities and that might factor in. Let's take a look at the next slide. There we go. This is one of the things when it comes to, and I know this may look quite a bit jumbled up, but basically these are different asset categories. And if you just look at the colors, and you can see there's no rhyme or reason here. There's no patterns to be picked up on. And this is the way the markets work. When you look at different asset categories, back in the 70s, for instance, cash was the thing to be, and money market account was the best performing asset category. And the worst performing back in that period, I think it was 72, 73, were small cap stocks. Now those small cap stocks at that time dropped about, I think, 40 or 50%, whatever it was, and then but the next it went on a 5-year tear where it earned a tremendous amount of money. The point of all that is we don't know which asset category is going to be the winner. You know, it can be large companies. The S&P 500 index is an example, and some of the returns I've been citing off of that. But a good portfolio is going to take all the asset categories that we've listed in here and put them together, and this is the other part. In putting them together, there's certain ways that you do that. Let's take a look at the next slide now. So, and that will smooth out volatility. Dr. Shiller won a Nobel Prize in 2013. He partnered up basically with the Shiller Index and Barclays Bank, and they created the Shiller Index. The Cape Shiller Index is one of the measures for the market, but in this situation, this Shiller Index is using market sectors, and they're using a methodology. We'll take a look at the next slide, in which they take these 10 market sectors, narrow it down to 4 basically that are the best performing with the least amount of volatility, and they do that by tracking how they've done over the last 12 months. And then and they create the portfolio then for, let's say, February as an example. And then at the end of February they'll go back 12 months and see if that's changed, and they'll tweak it a little bit, and this is all set up so then that'll create the portfolio for March. And at the end of March they go back 12 months. As you can see, each month they're tweaking this portfolio based on a momentum play, a momentum strategy of what's actually working and writing that up. Let's take a look at the next slide, in fact. All right, so they're using just the same thing, market sectors in this situation as opposed to asset categories. So a market sector would be things like, of course, financials, industrials, consumer staples, that kind of thing. Medical would fall into that, healthcare. All right, let's take a look at the next slide. Right, and it's showing the returns of that relative to the market, how it smoothed out volatility and had a better return. And then the next slide. And this was another index, and this one is the Merrill Lynch, I believe. Take a look at the next slide for me. This one is, this is the Merrill Lynch called the RPM. This was Bank of America Merrill Lynch. Same concept of blending together. Now we're using asset categories. If we look at the next slide. And we'll see again, we're looking at that momentum in a way that we can smooth out the momentum relative. So this chart is showing the S&P 500 in the dark gray there, and in the blue being the index, and showing how that is, in fact, giving us a smoother rate of return, and yet in the end, we're getting about the same rate of return. If we look at the next slide, this is, and then go ahead to the next one. That's just showing another view of that. So this is another one. This is the Mosaic. This one's put out J.P. Morgan Chase, and it's brought to market with Nationwide. These are all versions of index annuities that can be used in a portfolio in a place. It's another fixed type of instrument. So in place of bonds, this can be a great fit because it also has a negative correlation to the market, meaning it's going to smooth out that volatility and yet give us a really good return over time. If we look at and this one's made up of asset categories, stocks, bonds, and the like from United States, Europe, and Asia. If we look at the next slide, we can see that a similar process. Here we're looking though at asset categories as opposed to market sectors. So for instance, large companies, large cap stocks or small cap stocks. We look at stocks and bonds, of course, in that mix as well. So here we're looking at 15 different asset categories, and their process is that the methodology they're using, again, is a momentum strategy. They look at how it's done over the last 6 months, and they say which are the top 9 asset categories out of these 15 over the last 6 months. And then they weight them, meaning they put more money in the one that did the very best and then the next best and so on, and that becomes your portfolio again for February. At the end of February, they look back 6 months and they create the portfolio then for March. It's not going to change dramatically, but it's there. And then they smooth out volatility. If we have a tremendously volatile period, they may even, at that point, it may trigger a 1 week step out, let's say. All right, so this volatility measuring, let's take a look at the next slide. We can see, and then there again, the green is showing us a much smoother return, okay, as far as ups and downs compared to the S&P in the blue. And if we look at the next slide, we'll see again what the average returns are. So go ahead to the next slide. There we go. Now if we, in the middle there, what this is showing is the S&P 500 index for the last 20 years compared to the Mosaic index. The S&P 500 index, of course, again, the 500 largest companies, they make up 70% of the money that's in the stock market and outperform 90% of equity mutual funds. As I mentioned, the volatility is the thing we want to try to tame. And we can see in the late 90s when the market had a great run, and the Mosaic is just going to kind of plug along as it will. However, when the market in 2000 through 2002 dropped that 45% I mentioned, well, each of those years the Mosaic actually had a positive return. Even in 2008, when the market dropped 38%, the Mosaic made a little over 4%, had a positive return. And if we look at the average over the 20 years, we'd see that the market did about a 6% return, a little under that, and the Mosaic about the same. Just didn't have all the big ups and downs, but in the end ended up about the same place. So this is another area where you can, again, improve your overall portfolio. Let's take a look at the next slide. Now I've talked about sequence of returns. One of the things that we get into with sequence of returns is we see with this investor, and this came from Tony Robbins' book, Money Master the Game. 7 Simple Steps to Financial Freedom. Yes, we have similar titles. One of the things that Tony got into with this was, and it was a great example of showing sequence of returns. So if you're investing in, or if you're in fact, actually, let me go to the next slide first. We'll come back to Susan. We're going to go to John. Okay, there we go. So both of these investors, what they're showing in these two, in his example, is what would happen if you entered into the market, say in a period like 2000 through 2002, where you entered into a bear market when you retired and you're needing to take, say, 5% or about $25,000 a year and increasing that with inflation over time. Well, in this situation, this person would have run out of money, I think in around age 80, 82. They would have run out of money, would have only got about 560 some or 580,000, whatever it was there. I'm in trouble seeing it myself. on our $500,000 that they had in their retirement account. So imagine you average an 8% return over your lifetime, all right? From the time you retired, he averaged 8%, but yet he ran out of money. How could that be possible? Well, let's take a look, and the reason is because of that big drop in the market over that first 3 years, and then what impact that had in setting you back when you're taking money out of your portfolio. This is why sequence of return risk is something we address in your overall planning. So an example would be, we'll go back to that first slide with Susan, and we see that Susan got the same result. She had an 8% average return, but when she retired and started taking that same amount of income, she was in a bull market. The money the markets were doing really well. She didn't hit the bear market until later. So in her situation, she was able to take out over $900,000 and never ran out of money. In fact, had over $1 million still left. Tremendous difference in terms of the result. All right, so we can go ahead and what's the next slide, by the way? Well, we'll come back to that. All right, we're going to take a break anyway. So one of the things here that sequence of return, when you're taking money from your portfolio and you go through volatile periods like this is why asset allocation, again, is so important, and having a plan, a financial plan that helps not only minimize volatility, but maintain your income so you'll never run out of money. Right? We're going to get into that when we come back from this break. I'm going to show you how that can work for you. All right, how that we do it with my clients and how you'll be able to take advantage of that as well. All right, but join me here. First, a quick break, and we'll be right back on the Retirement Report.